Hey everybody, welcome into Mining Stock Daily. And this is a somewhat of a market commentary discussion, and literally just a discussion I recorded with my friend Julian Brigden of MI2 Partners just yesterday. Typically, him and I chat up in the mountains when he's back in Colorado, just about markets, and usually the recordings specifically for Mining Stock Daily. And this was more of a general discussion, as his partners and subscribers were also kind of interested to learn more about the mining and exploration space, and that's where I came in. And so what you're about to hear is the first part of our conversation, where we talk a lot on the macro and obviously digging in with him and all his expertise on what we're seeing and the U.S. dollar and the bond front, and then everything else of what's driving markets higher currently. So then the rest we will leave for Julian and his subscribers. So hope you enjoy this conversation with my friend Julian Brigden. All right, everybody, welcome into Mining Stock Daily. It's that wonderful time of year, and I believe this is the third or fourth year in a row I've made the pilgrimage back up to Beaver Creek. Not for the Beaver Creek Precious Metals Summit. We are still in the doldrums of summer, where I get to hang out on the patio at Bachelor Gulch here with my friend Julian Brigden, who also has made the trip back to Colorado. So, Julian, good to see you.
Good to see you, mate. How are you?
I'm great. I haven't seen you since your wedding.
No.
It was a beautiful, beautiful wedding.
Thank you very much indeed. No, it was. We had a blast. It was just over way too quickly, and now it's unfortunately back to reality.
Yeah, but you guys know how to party.
Yeah, it was a good bash, wasn't it?
It was a good bash. Like I was really happy. Like, it started early. Mm-hmm. It was an early afternoon wedding. And literally, we didn't leave. And we were early to leave at 11.
Yeah. Yeah, so. UK wedding. I think we closed it down at 12:30, and the kickoff was 2. Yeah. So it was plenty of. I saw the drinks bill. It was good. We did well. We did well.
Well, I played my part. I will admit, I played my part that evening. Listen, I remember vividly last year. We were sitting here on the same patio, and you were kind of pounding the table about not only are we entering this kind of seasonality, volatility in stocks. And I remember you talked about, at the time, weakness in NVIDIA. And sure enough, literally the next week, NVIDIA had a big sell-off. And obviously that was then, and it's back up to highs. And we're here today, post-CPI. So we're recording this Tuesday morning. CPI print has come out. Stocks are surging. NASDAQ's hitting all-time high. S&P, I assume, is hitting an all-time high once again, pretty much up there. The Dow is kind of doing whatever the Dow is. The 10-year yield was 10 basis points kind of teetering, and gold is stabilizing. Mm-hmm. There's a lot of speculation, so maybe let's pull out the big chessboard of the macro here, because I think if the chessboard really hinges on the dollar.
Yeah. So I think when I take a step back, I look, there's two things that the Fed's obviously focused on, and one of them is dominant. And those two things, and this is really all you have to be concerned about when you're looking at the macro, is the labour market and the inflation story. Now, starting in reverse order, because this is what we had this morning. If you look at the inflation picture, it is, I don't think, in any way, shape or form, it really justifies an easing in isolation. And if you had a single mandate central bank that was focused on inflation, I don't think we'd even be having these conversations about easing. We had core service inflation again, coming in, stuck in the sort of upper 3%. That is 75% of core CPI. We had a bounce in core CPI. I think the market took some relief that some of the goods pricing that they were expecting to come through from tariffs didn't come through with quite the degree of gusto that they expected. But that has left core CPI at the highest levels since 1993. And yet we were sitting here contemplating, numerous rate cuts, right? I mean, even before Jay Powell leaves in the spring of next year, we're pretty much pricing in 100 basis points of rate cuts. Now, so I'm not sure that it really justifies a rate cut. Now, when you look at the Labour side of the equation, that's obviously what everyone is concerned, that we're losing an awful lot of momentum there. Our work suggests that in actual fact, yes, we've seen a material slowdown in hiring, but we're not seeing the firing, and as a result, most of our work doesn't really show any increase in the unemployment rate. It's kind of stuck in this very low 4%. So, I mean, could we see 4.3? Sure. Could we likewise see 4.1? Sure. Are we going to see 4.8? Not in my work at the moment, but it looks out 3-4 months. And likewise, you're going to see under 4. No. So we're kind of plateauing here. And to put that into context, it's an incredibly low level of unemployment. Everyone's very fixated on the headline rate. You know, we saw the big revisions. The market got very excited by those. But there were some dynamics going on there, which I think we have to understand. I mean, a large percentage of the rise in non-farm payroll under the Biden administration was new immigrants entering the workforce. That is now arguably reversing year over year. Yeah. And when you look at things like remittances overseas from foreign workers in the US, strip those out, and your what they call the break-even rate of non-farm payroll, so the rate that holds unemployment steady. If you strip out that growth in the labour force that comes from immigrants, is much, much, much lower, Trevor. So if you were looking at a rate, under Biden of, let's say, 90 to 120,000, without immigration, that rate is sub 50. And that's what we got. Yeah. And that fits with a unchanged unemployment rate, a sticky wage rate, and you can see that from all the PMI services. You could see that from the Employment Cost Index, you can see that from the Atlanta Fed numbers. These wages are getting stuck here. So I look at all this stuff and go, from a macro perspective, I don't see really the justification for certainly aggressive rate cuts. Could you chuck in a 25 or maybe even 225s just to err on the side of caution? Mm-hmm. Sure. But we seem to be committed to more aggressive cuts. Now, I'm a little concerned we might get a pushback from the Fed, but...
Pushback in what way?
In that they may say, let's say they go in September and they say, this is a precautionary cut. We may go once again, but that's kind of it.
Potential, instead of like the 50 the market's counting in a 50, they say here's 25.
Here's 25, and maybe you'll get another 25, and after that, piss off.
Well,
right?
Everybody would hate it.
We're done, right? Yeah. We're going to wait, right? Now, I think that's what they should do, but we know that Jay Powell's term is limited. We know that the president is determined to get rates lower. I'm not arguing that, some people have argued, Greg Ip from the Wall Street Journal, I have a great deal of respect for, and is a fantastic macro financial journalist, has been talking that essentially the government is trying to, or the administration is trying to push us into this point called fiscal dominance, where the role of the central bank no longer is tackling inflation, but it's basically stabilizing the support, is stabilizing the sustainability of government debt, right? Where they're concerned about the solvency of their boss.
But hasn't that been an argument for a number of years here?
I mean, sure, but we haven't seen anyone pursue it with the same vigor that President Trump is.
And I would say at the time when the institution of the Fed, as long as with other entities of statistics out of this government, the autonomy is becoming more and more in question. I mean, I can see that definitely.
Look, I mean, I'm probably going to upset people, but I've had, 4 conversations with clients this morning after the CPI numbers and after the announcement of the changes at the BLS, at the head of the BLS, and particularly that comment that the replacement, I can't remember what his name is, said on Fox News about potentially suspending the release of the data, all 4 clients, and these are big macro PMs in the US and in Europe, they said this is the sort of step you'd expect to see in a banana republic. So,
of course,
I put all this together, Trevor, with a macro backdrop that tells me you really shouldn't be easing, but we're easing. So we're looking at what we would call loose monetary policy. So monetary policy shouldn't be this easy, but it is going to be easier. We'd still have ongoing loose fiscal policy. And this, long story, as we get back to the original question, this should be dollar negative.
Yeah.
And, that's one of the reasons why I'm interested in talking to you is, we caught the dollar move at the beginning of the year. It was a non-consensual call when we said we think we're looking at a weak dollar year. When we look at this dollar, we look at something that, hit kind of its trend line, off the 2011, if you just look at, say, the dollar index or a broad dollar trade-weighted index basis, they've all kind of hit their trend line back in sort of April, May. We subsequently bounced. It now looks as though that bounce may be running out of steam again as we see the data, a Fed that seems willing to roll the dice, and cut in an unjustified way. If we get that dollar break in the next few months, I'm thinking we unleash this reflationary wave because the dollar is the denominator of most assets. And while I wouldn't necessarily be surprised to see US stocks rise in that environment, they typically underperform. And this is something that I've been quite keen to stress to people, that if in 5 years' time, which is my base case, we look back and let's say the Trump administration has got everything that they wanted, right? They've got a significantly weaker dollar, they've got a re-onshoring of manufacturing, they've got a lower current account deficit, right? All of them are laudable aspirations to have. Mm-hmm. The US equity market in that scenario will have almost certainly, in let's say non-dollar terms, underperformed.
Sure, and I agree with you. I think there might become a point, and might actually happen sooner. And you're starting to see it. Like I have a lot of my own capital allocated to emerging markets, specifically to South America right now. And I got to be honest with you, like it has been doing great.
Right.
I'm super happy with it. Slowly, gradual rise up, stair steps up. I get paid a dividend.
Yep.
Just keep it and forget it. But that isn't necessarily a trend by any means by the masses. And so whether we get a reflationary type of environment where, the S&P and the NASDAQ continue to look and run hot, and you say, oh, the S&P was up 12% year over year, and which is probably, I'm not saying that's not a speculation. That could definitely happen. It's like, great, but so many people have money into that market, into the U.S. markets, that they haven't actually paid attention, but like, but Brazil's up 20. Right,
exactly. And Europe has still outperformed the US when you look at it in currency terms. So, and I think, one of the things that I wanted to get you here for is if we start to see, investing in commodities has been such an unfashionable space to be in. And I know we've talked about it over the years, and, if you look at, say, gold has done as well as the S&P up until certainly very recently with this latest sort of run up, and it's sort of treading water a little bit. But even silver's done really well relative to the S&P. So you get this sort of money illusion, what I would call money illusion, where people go, oh, well, I'm up, 12% in in US stocks, and you go, but if the dollar's down 12%, then in actual fact, in concrete terms, you've made absolutely bugger all, right? Because your dollar your money goes no further, and maybe it does in the US, or when you account for inflation, probably don't, as we sit here and drink, God knows how much an iced tea is going to cost me here, but I'm sure it's up more than 12%. So when I look out and we go, okay, let's assume that the intention is wobbles aside, so we get maybe a 10% or something at some point. We know September tends to be a potentially bit of a wobbly time for the world, but if we're moving into an environment where you buy that dip yet again, We're running things hot. We're running things hot where policy is not appropriately tight, where the dollar starts to show signs of clearly breaking down. When you talk to your guys and you go more micro than me into that commodity space, what are you watching? And you mentioned Latin America. I mean, I've been asked, and I said my favorite trade, PA, is Vale so the Brazilian mining company in Brazilian real.
Right.
I want to take the currency risk, so I just buy the ADR because I get the currency effect.
Yeah. So I think one of the things we've been saying, let's just big backdrop watching the precious metals complex, because we're really talking on the big. But what happens to precious metals on the back of a falling dollar, right?
Yeah.
Let's take a couple minutes and talk about that. When I look at the gold chart, and despite the volatility we saw last week with supposedly tariffs on gold bars in the U.S., which turned out to be a nothing burger.
Yep.
But Julian, I see a chart that wants to go higher. I can see resistance at the top, but I see higher lows, and I can see a squeeze happening here, which maybe makes me believe that we will get some sort of clarification with an interest rate decision in September. I think a lot of it hinges on that. But what I see in this move is a dollar that wants to go higher. Every time that thing dips, even this morning or yesterday, the gold futures were down $86.
Right.
And that was still a higher low.
Right.
There used to be a time where gold was down $100 and it broke the trend.
Yeah.
Not this time.
Not this time.
And so obviously with that, the gold miners are just raking in cash.
Right.
Business has never been better. They are managing their capital allocation really well. They're not like throwing capital at stupid projects, high risk exploration plays that they were back in the last cycle, like 2011. They're being very smart. There's a lot of consolidation going on. There's mergers, there's acquisitions. And so the major producers are just raking in the cash. Now we're starting to see a lot more movement, M&A acquisitions, more of the mid-tier producers.
Okay.
Let's say $500,000 to maybe $1 million or 1 million ounces production a year. And
are those guys in the junior minings?
So we would call these a mid-tier producer,
Okay.
but I think this is where the juice remains. And
Okay.
so if you take a look at a number of those mid-tier producers, you will see charts, and maybe there's one or two positive producing assets within the portfolio, maybe a development project or two that they are pushing through with permitting or exploration and technical studies. When I take a look at those, I see charts that have had a decent run, but they're consolidating here.
Right.
And with the gold price consolidating where it's at, I think we're going to see the next big move in gold will bring these mid-tier producers up.
So look, I mean, we don't do in MI2, we don't do single name stocks, but I don't in your work, Trevor, you definitively do. And so when you look at those names, what are the sort of stocks that you would put that on your radar?
So, and I don't want to maybe go through specific names, but I can narrow it down.
Right.
U.S.
Okay.
U.S. gold producers, gold developers. I think with the permitting regime, that looks like there's changes happening within this administration. Listen, I'm a big critic and skeptic of the Trump administration, but what they're doing with permitting in the U.S., along with, I think we will see some sort of CapEx boom here pretty soon outside of AI data centers. I think that's a great place to be. And I'm actually pretty bullish Canada.
Right.
Canadian producers as well, I like.
Are there any ETFs where you can get decent exposure? Would it be the junior gold miners, or do you?
I mean, so the GDXJ has actually somewhat outperformed the GDX a little bit here, and that's not really a junior. There's a lot of producers. Yeah. And it's kind of a mixed bag in the GDXJ, but that's a pretty good bellwether of smaller gold producers that you can definitely watch. So I think it's like full sales for U.S. gold production right now. I want to see a little bit more clarification on copper production. We had that
Yep.
The scare, I mean, was tariffs on, tariffs off, crash in the COMEX copper futures. We need to see kind of the weather clear a little bit there to get better. But be honest with you, if you're talking about U.S. copper production, you want companies that can create cathode straight from the site, not something that creates a concentrate that has to be shipped to a smelter
Okay.
to get refined, because the smelting capacities here in the United States are
Non-existent, right?
well, not non-existent, very few.
Right, okay.
They don't have the capacity to process what we demand.
Right.
So that stuff has to go to Asia, mostly China.
Yeah.
And I mean, the narrative of the game here is like this administration, and I don't think it's going to be a trend that breaks, even if a Democratic president comes in 3.5
Correct.
years. I think this is a trend that's going to stick around for many years, is a reshoring of our supply chains.
Mm-hmm.
And that is a good trend.
Correct.
Now, how do you do it? And this is where I maybe have criticism, is like, well, you can't do it with a sledgehammer. You have to come in with a scalpel and do it strategically. And that's where I think the mistakes are coming in from a policy standpoint. But at the meantime, if you're looking at copper, you need cathode production in-house. And there's a handful of companies.
Okay. I mean, is there once again, is there an ETF that you're watching in that space, or?
No.
Okay.
No.
Cheers, mate. Well, thanks for that. Okay. So what about the big one that everyone's talked about? What about rare earths?
There's, again, same dynamic.
Canada and the US.
I actually think Brazil's pretty interesting
Okay.
here. There's a lot of rare earth endowments in Brazil. What's interesting, looking back at the MP Materials deal, is not only the U.S. government and the DoD coming in as an equity holder, which is an interesting dynamic on the philosophical you and I can have about the role of capitalism. in the US government, is that they put a new floor of production.
Right.
And that was just for neodymium, praseodymium, which is what MP Materials produces.
Right.
So the playbook's there, and we have this whole list of critical materials that's important to the U.S., and that's been in place, since the IRA under Biden.
Yep.
That document has not gone away.
Right.
You haven't seen Trump ripping it up
Right.
at all. In fact, they're doing more allocation of capital with that. So you take a look at that list, and you take a look at these really niche rare earth metals. It's like, well, why wouldn't they replicate that for dysprosium?
Okay.
And where do we get and then you can start doing your homework with like, all right, where does allocations of dysprosium or gallium or
And do we have those in North America?
So there are certain plays, a lot of them are byproducts
Okay.
that can come in. Where we are lacking, and I think this is kind of a bigger picture, where we're lacking with rare earths is the processing.
Okay.
40 years ago, when we gave all this business to China, we kind of lost the processing capabilities. Not only to the actual infrastructure of processing, but the brain power, the human power of processing. So that also needs to...
They become as... Rare earth engineers have become as rare as JGB traders.
JGB, yes.
Yeah, we're sitting here on the day where not a single contract traded in the 10-year JGB futures.
Really?
Yeah.
Why is that?
Because they capped,
nothing there.
They suppressed it for so long that there was no money to be made, and there's no real JGB traders left anymore in Tokyo.
Can I tell you a funny story, actually? Yeah. It's kind of on the bond market. So I'm trying to diversify. I'm so heavy in metals and miners, like trying to diversify, be a good investor. I think you'd be, every day I wake up and with my money, I'm like, what would make Julian proud of me today? So I actually bought tips.
Okay.
I bought
inflation protection.
Inflation protection 2046 tips. And I asked my my manager who manages the 401k, I was like, do I get a free pair of slip-on Skechers with these things? Because I feel really old.
Yeah, exactly. Look, we talked about this before we got on thing. I mean, I think the idea of running it hot is, so in other words, allowing nominal GDP, and it's important to understand, it's real growth plus inflation, to destroy the value of the debt by inflating it away.
How did we get here? In 6 months, remember, we were talking Mar-a-Lago Accord type ideas back in January or February. And there's still probably some takeaways from that. They're still kind of alive. But for the most part, that idea is dead and quiet.
I don't know whether that's fair. I mean, the whole purpose of Mar-a-Lago was, in a way, to enable you to run it hot, right?
Sure.
And that's, look, when you've got this much debt, Trevor, this 3 options, you can print your way out of it, right? You can save your way out of it, so you can tax, cut spending, right? That's
definitely not happening.
That's not happening. I mean, I think there was some aspirations around Doge, and that fell flat on its face. And, I've been on the record for saying, one of my clients is a big emerging market manager and has been doing this many years. He said, the time that people realize there's a problem is when emerging markets try to address their fiscal imbalances and then realize that they can't. And the market goes, shit, right? And then you dump the bond market and you dump the currency and so on and so forth. And I think we got to one of those. And now I think the hope is that we can kind of grow our way out of it, right? Mm-hmm. So we run it hot. Now, I think that links back with the first one, where you run high nominal GDP as well, and you inflate your way out of the debt. That's the only logical way of doing it. And then at the same time, you suppress, either directly or indirectly, the rise or the importance of the bond market in terms of affecting the debt. So you either issue, which we talked about as well, that Scott Bessent, who was my client for many, many years, super smart guy. Everyone was very critical of Yellen because she was pushing issuance to the front end of the bond market, issuing heavily in the bill market. And then that's exactly what they've done, because we cannot afford as a country to fund our debt at 4.5% to 5% in 10 years or 30 years.
Yeah.
If it's down at 2.5%, which maybe we can get 1 year bills down to, if we cut rates enough, put enough pressure on the Fed to get it down there, then it's sustainable. But it's just going to have consequences, right?
So how do you steepen this thing? I mean, if you really got to give more focus to the long end of the curve, but yet the market isn't supportive of it. I mean, not the market, like the macro is not supportive. Like just the fundamentals.
So there is I think, for most people out there, this is probably an irrelevant story, but for macro traders, this is very important. So the curve, the steepness of the difference between 2 years and 10 years, or 5 years and 30 years, is something that a lot of macro traders trade. For most people out there, what matters is the absolute level of those rates. They don't care about the differentials. So we could have a situation where the curve steepens, and that sounds quite dramatic, and it could steepen quite a lot. So we're at the moment, if you look at, say, 5 year against 30 years, and the reason why I'm picking 30 years is because that's where most of the pain has been seen in global bond markets. It's the first place you'd expect to see concerns about the sustainability of long-term debt. We've seen it in the UK, we've seen it in Japan, we've seen it in the US, right? Am I really going to be paid back that money in 30 years' time? Okay? So if you look at that 530s, it's just over 100 basis points. Now, it is entirely possible, and in a normal cycle, it wouldn't be unusual to see that curve go to 150 or 200 basis points. Now, you might go, oh my God, does that mean that 30-year yields are going to rise another 50 basis points or 100 basis points? So we're going to be almost 6% on 30-year bond yields. And the answer is no, not necessarily. Because what could happen is that the Fed could cut rates and cut them sufficiently that 5-year yields fall.
Right.
And really what happens is that steepness occurs with 5-year yields falling as they artificially cut rates, and maybe that long end yield not rising that much. And that's a big trade for macro guys, right? And it's important, but it might be good for the economy because, you know, you can go and get your 5-year car loan, and that might be at, you know, 3%. Right.
So this is the interesting. So, you know, I've been talking to a lot of gold bugs for 8 years, and please don't hold it against me. But, you know, for a long time, I listened to these arguments about debt and the value of the dollar, purchasing power, and it's always come back like gold is truth. And a lot of times I've listened to them because they've had a point, but it hasn't necessarily played out. But I feel like in the last, ever since COVID, like their playbook has definitely been playing out in almost real time to the point where, like, oh shit, they actually might be right this time.
Look, I mean, in a world where we have discovered the power of the printing press, which is definitely the case since 2008, and then again proved during COVID, if you print a lot of money and it's the denominator of the risk asset, then what you should see is the value of said risk asset rise to offset the amount of money that you're printing, right? Just because, you know, if you think of it in a very simplistic way, there's one good that you can buy, and, you know, it's you and me in a world. You have the good and I have the currency, and I want to buy, but I only have $1. I can only buy your good for $1. Now, if all of a sudden I have $2 because I've printed more, then the price of your one good that I can buy rises to 2, right? I mean, think about it from that purely simplistic perspective. But I do think that this is an awful lot of what we have seen, Trevor, right? Together with other macro effects, you know, in terms of financing flows that, you know, I think there's a large extent to which the US equity market is outperformed because as the US economy has boomed, which in itself is a function of the US equity market, because the wealth effect has been the driving force between the spending of the top 20%, and they are all of the discretionary spending, and 50% of total consumption in the US now, that as that's risen, the current account deficit has risen, and that's sucked in more and more foreign money into, I think you could argue, this increasingly fragile Ponzi scheme, but we don't have to go down that route at this point. But, you know, you do have this just sort of circular vortex that sucked more and more money in. And now we're at this point where how do we get ourselves out of it? And I think the most obvious thing is that we try and inflate away the valuations. Right. And the obvious way to do that would be to weaken the dollar. And we've seen, as I said earlier, the gold is kept up with it's zero yielding asset has kept up with the S&P, right? Where these companies earn lots of money, right? And to me, the real question is, if in this next stage, we haven't talked about this is going to broaden out away from gold into some of the higher beta commodities. So is this going to start to really move into silver? Because silver, it wants to go. It wants to go. Yeah, I think it wants to go. And that to me will be the sign that this next wave of a weak dollar induced global reflation story and ultimately inflationary in story is happening. And what I've been keen to stress to my clients is, sure, the S&P can go up in that environment, but you really need to broaden your horizons outside the US.
So, I mean, if you want to get weird on silver, let's do one up and talk platinum and palladium. I mean, and obviously there's an industrial component there, and we don't necessarily talk about the dynamics of catalytic converters and the production out of Russia and that whole mess. But if you are going to start seeing this reflationary trade that's going to hit the precious metals, platinum and palladium have made a pretty big move, but they're nowhere near where they would be trading in a normal big precious metals bull cycle. That ratio is still pretty low.
Certainly to gold, right?
Certainly to gold. And so that is one thing you could be watching. And I've actually put on some trades in platinum and palladium, anticipating that, because I'm seeing producers that are just not getting the love out of their platinum and palladium bodies that they should be, which is quite interesting. And those are out of Canada.
Right.
So, I mean, you can start kind of going down the checklist here.
Right.
If this really is what is about, if we think this is going to happen.
Now, the only thing that I've always worry about, and I must admit, I mean, this is that historically, true bull markets in precious metals are born out of bear markets in equities.
Yeah.
So you go back and you look at the 30s, the 70s, the post-dot-com period. And those were true. 2002 to 2008 was a true bull market in precious metals. And yet, I wonder whether, because we've discovered the printing press, we have some way of avoiding that bear market correction in equities, and kind of we just get a relative outperformance trade. But do you have any thoughts about that? Have you spent any time thinking about that? Because clearly...
Cycle timing?
Yeah, because it's sort of like, look, I could sit here and go, and this is very hard when, as I said, as a if you're a professional investor, you can run, long silver, short the S&P, right? It's very hard to do that as an individual investor.
Right.
And you could sit there at the end of as the professional, you could go, well, I outperformed by X amount of percent, but the problem is the S&P drops 50%, but your silver still drops 30%, and as an individual, you're rarely going to be short something, right? So then you'd be like, well, I just lost 30% on my silver trade, whoopee, right? So if you spend any time looking at that nice, what I would call the nice, nasty rotation environment.
Yeah, and I think some other people have done more work in that and better work than I have, but if you look back at, like you said, the 2002 to 2008 precious metal cycle, and I would say ended in spectacular fashion 2011.
Yeah. Which is the absolute low on the dollar. Silver's high, I think, was in a week of the arse low on the dollar.
Isn't that amazing? So I guess I'll answer you, but when do you think this precious metal cycle began?
I don't know. I'll be honest with you. I'm not convinced.
2020?
No, I'm not even convinced it started.
Wow, really?
In the sense...
Have you seen a gold chart?
Yeah. But have you seen an S&P chart? Right?
Yeah.
In the sense that I think we have a bull market in assets. What I'm not convinced yet, Trevor, is that I think you have some embryonic signs, for example, that silver is starting to show signs of outperforming gold for the first time. If you look at it on a charting basis, we broke through a trend line. I'm going to butcher this one because I'm going to forget, but I think it goes back to like 2021, and there's a nice uptrend in the gold-silver ratio.
Right.
It broke. It came back recently and retested the break. This is on a log chart, and now it's breaking down.
Well, it was at 100. The gold-silver ratio was at 100.
Right. So the point is silver is now outperforming.
Right.
Now, silver outperforming is typically only occurs in a true precious metals bull market.
Right.
What I and you only typically have a true precious metal bull market when miners start to outperform the physical,
which is what's happening,
which is beginning to show signs.
Yesterday's a great sign.
Yeah, I mean, just beginning to show signs, and we've been long GDX, and that's really been a great trade, right?
Yesterday was a huge sign for me. Gold's down $86.
Yeah,
the GDXJ gap down lower on the open and climb their way to flat.
Right. I mean, one of my favorite trades since the beginning of the year was XME, the mining metals ETF, right? Yeah. So you asked me, do you think you're in a bull market for precious metals? And the answer is, I think we're in a bull market for assets, right? What I want to see are some of the things we're just beginning to see the signs of.
Yeah.
Right?
Yeah.
And I've drawn attention to I don't know whether I think you've interviewed with these guys, the North Star Bad Chart guys.
Yeah, they're great.
Yeah, I mean, odd name. I think great backstory. The guy was like a meteorologist for the Ministry of Defence, and his job was to measure the fallout clouds from nuclear blasts. And I thought that was bloody cool. I just thought, so I started listening to the guy, and I like their approach.
Kevin,
yeah. So they're very much into this. You need to see this rotation into these sort of assets before we get the true, not just the bull market in bloody housing and stocks and precious metals, true precious metal outperformance. Now, they're a big believer that typically it comes out of pain. I'm open to the idea that if we can weaken the dollar enough this time, that maybe we can avoid the pain. I'm not convinced.
Yeah.
But at least for now, because I looked at this the other day. I mean, if you looked at the ETF values, right? The ETF value of the tech ETF, so the XLK was like $80 billion. And
you could buy the GDX 50 times over.
Right, and the equity market cap of XME, so the mining and metals, was like 2. Right. So to your point, you could buy it 50 times, 40 times over, or whatever it is. So it only takes a tiny allocation to move into this. But I do think, to go back, a long-winded way of saying, I'm not truly convinced yet that we have started a bull market in commodities, and for that I think we need the dollar to break lower. I think everything that it looks like they're lining up that the Trump administration is trying to achieve. Remember, to go back to your Mar-a-Lago thing, they absolutely wanted a weaker dollar. It's an integral part of rebalancing the current account and the fiscal deficit. And I think the objective, as I said, 5 years from now, Trevor, is that the S&P will have gone up a little bit, but you'll have found that in foreign currency terms, it might be down 30 or 40% relative to certainly gold or silver or copper or European stocks or the Nikkei. Right? You want a stock market that looks friggin' sexy?
Yeah.
Go and look at the Nikkei. The Nikkei looks like it's breaking out. One of my favorite PA trades has been Japanese banks in dollars, and you just and that thing just looks like if you pull up the Topics Banking Index, double top, we just blew out yesterday.
Yeah. Oh, interesting. We had talked about a little bit about emerging markets, and I've got capital allocated to Latin America. I know it's an interesting story here is Argentina. Obviously, Milei's done a really good job of bringing capital back, foreign investment back into Argentina, bringing Argentinian capital back into Argentina. There's an interesting dynamic here. His midterms are in October, and we will see how much him and his party keep or gain more control of. And that's going to have a big implication on the resource sector and their RIGI investment policies that they've put in place. That's also one place to watch. So pay attention to the Milei midterms. But obviously they're trying to open that up, not only for lithium, but the copper endowment there is just enormous. And there's some big tier 1 projects that are on the cusp of getting either acquired to be built or will be built by themselves. So it's something to watch too. So I think,
and unlike Brazil, I mean, US friendly, right? I mean, Milei and Trump are.
Yeah, but honestly, I mean, Milei and Trump are friends, but honestly, I don't think it'd take too much for Brazil and Trump to get back on better terms. I mean, it could have already happened right now while we're talking.
Right, yeah. I mean, I can't cope with that. The tweet fest or it's Truth Social Fest, right?
The information presented should not be considered investment advice. Mining Stock Daily and its affiliates are not responsible for any loss arising from any investment decision in connection with the material presented herein. Please do your own research or speak with a licensed financial representative before making any investment decisions.